Alrighty. Now the company paid, again there's that word paid, $1,000 of rent in advance. So we're going to credit cash for $1,000, and you just do the cash first because that boxes you into the rest of the entry. Now you have to have a debit, and we're going to debit, we paid rent in advance, so that would be prepaid rent, $1,000. Okay, and if you think about it over here, that would be prepaid rent. The asset prepaid rent increased with the debit, cash decreased with the credit. Alrighty. Now we borrowed money from the bank, so think, which way is cash flowing? Cash is coming in, so I would debit cash. And next, we're going to increase a liability, so I would increase notes payable. It wouldn't be an account payable. An account payable is like with a vendor, somebody who we buy from. So this would be a note with the bank. And now we paid for the cash that the equipment that we purchased up here in number 5 for $2,000. So if we paid, again, cash would be going down. And accounts payable would be decreasing. Okay, debit the payable, credit cash. Okay, is this starting to go into your head? And now we're going to issue, okay, $4,000 in common stock. Let's call that company receives $4,000 from owner. I think your sheet says that. And which way is cash going? Cash is coming in, so we would debit cash, and we would credit some capital account, whatever we have for owner's equity. And if you look at it over here on this sheet, I would have it increase to cash with a debit, increase to owner's equity with a credit. Okay, we're almost there. Now we bought $100 worth of supplies on credit. I'm going to increase the asset supplies. And we bought it on credit, so I'm going to increase accounts payable with a credit. Okay, now pay for the supplies. We're going to pay for it, so there's pay again. We know that cash is going to go down, so we'll credit cash for 100. Whoops. And I'm going to decrease my liability accounts payable by $100. Okay, and now company purchased $200 of supplies on credit. Again, I'm going to increase the asset supplies by 200. And this is on credit, so it'd be a credit to accounts payable for 200. Okay, let's see if we can get through the rest of these now. We've got, those are all just balance sheet accounts, and notice how I've got the debit to the left and the credit to the right. The debit always has to go first, okay, and then the credits come later. So now for the income statement, we're going to have revenue and expenses. That's what all of these transactions involve. Well, they'll involve one account from here, one account from the income statement, and one from the balance sheet. Okay, there are no entries that are just only on the income statement. So they sell services for cash. So cash is coming in for $4,000. Tell I like $4,000. And then we're going to have service revenue for $4,000. Okay, now we sell services on credit. So instead of getting cash, we've got accounts receivable. We've got an account receivable. It's like an IOU for $1,000, but we still recognize service revenue. Okay, now the company sells services for cash. Cash comes in. How much? $3,000. And again, service revenue. Are you getting the swing of this now? I wish I could see your faces. Now the company sells services on credit. Accounts receivable, 2,000. Service revenue, 2,000. Okay, all right. Now the company is paid for the services rendered up here in number 17. We're paid for this. So I'm going to debit. Paid means we received cash. Cash is coming in, and that's $1,000. And now I'm going to decrease my accounts receivable. Notice the spelling of that word. Okay, now the company is paid for this transaction for number 19, the $2,000. It'd be just like the other one. So cash comes in, 2,000, and I'm going to decrease accounts receivable. You know. Okay, now we've got a few. Now let's look at how the expenses will go. The company paid wages of $2,400. So we know the cash is going down. Expenses are debited to increase them. So I'm going to debit wage expense. And credit cash. Company pays a utility bill. Again, the word pay there. Pays a utility bill of $500. So I'm going to have utility expense. And cash. That'll drive me crazy. Okay, now the company pays advertising. So I've got advertising expense. Increase the expense with the debit. And we're paid it, so cash is going down. And credit cash. Now this is a little bit tricky. The company receives a bill for electric. If you receive a utility bill, that means you already used the electricity, so it would be an expense. All right, it was used in generating the revenue. So I'm going to have, well, you could have electric, but we can just call it utility expense for 300, and this would be accounts payable. $300. And now they pay the electric bill. So now I'm going to decrease the payable and decrease cash. How is this? You've got to let me know how this goes. Okay, decrease the payable, decrease cash. Now they receive a bill for repairs. So somebody already did the repairs. I'm going to recognize repair expense. And this would be another accounts payable. I think it's $500. Okay, and now we pay the repair bill. So I'm going to debit accounts payable, decrease the payable, and decrease cash. Almost there. Okay, now the company received $2,000 for services. It received, so cash is coming in. We're increasing cash by $2,000. And this would be for services that we already did, so this would be service revenue. And now for the last one, the company provides $1,000 worth of services on account. And believe it or not, this is the one that you're going to forget. So if it's on account, that means we've got money coming in. We didn't get the money yet. Accounts receivable for $1,000. And recognize service revenue for $1,000. So we increased the asset accounts receivable, and we increased service revenue by $1,000. Now this whole sheet is perfect practice for you. All of a sudden when it clicks in your head, you'll know. And I find this helpful to think about, especially if I've got a, like if you've got a complex transaction, this is in my head. I hope it helps you, but if you like the image from the book better, go ahead and use that, whatever works. Okay,